literally the most important chart in the world. That's the way you got to think about it. The most important chart in the world. Hey guys, and welcome back to another video. So, the pandemic over here in the UK is hopefully coming to an end. Now, for me personally, one of the biggest lessons that I learned in the pandemic was obviously some life lessons in myself and my own journey, but also within the markets. Now, what I realized was a big shift in what was moving the markets. There's a famous phrase that we use where when fundamentals come out, the technicals disappear or they vanish. And when the fundamentals are over, the technicals reappear. Now for me, just looking at this cable move on GBP USD since October, it's all been fundamental and macroeconomic basis based on vaccine distribution. A lot of the moves that have been happening in the past few months have been based off data and more fundamentals, and I would say less technicals. So what I've been looking into and what you're going to see in a video in a minute is me going to the trading floor and explaining a little bit more about the 10-year Treasury yield, the most important chart in the entire world, the safest bond. And right now the 10-year Treasury yield has been screaming to 7-week consistent bullish 7 weeks, and that has actually taken the dollar along with it. So I'm gonna go next door and explain to the traders about the 10-year Treasury yield, and hopefully you guys enjoy some of the free information. Thanks. But with the yield, it's basically showing where the US economy will be in a few years' time. So, for example, if you look at the 30-year yield, depending on where that is how much confidence people have in the American economy and the United States dollar. Dollar is correlated to absolutely everything. So if you want to try and basically think of macroeconomics and fundamentals and where do you want to start, you just got to focus on the dollar. And everything else you can learn at the same time or on the side. Of course, there's a difference between fiscal stimulus, which is what people are giving out now in America, which is paid through taxes and stuff back. But the yield is what institutions buy. So if you look at basically like a hedge fund, the way a hedge fund works is it will get maybe 20-30% of the money invested and put it into slightly more riskier things. Might put it into more riskier, maybe cryptos, might put it into equities, stocks, you name it. But there's a large part of the money that they're going to invest, they invest it into a yield. And there's also a thing called negative yields. So, this is kind of confusing, but there's yields out there which are negative. So imagine it's like minus 0.5%, right? So over a year, you're going to lose 0.5%. Hedge funds will still put that money into that yield. And you're probably thinking, well, why would you put it in if you're not going to lose 0.5%? That, in the big institution world, is known as a safe asset. That it ain't going to go away anytime soon. Because that one's backed by the government, it will always be looked after. It will always be looked after. And there's different types of yields. So obviously here we have the T-note, which I'll be just explaining in a minute, which is the US one. No, so basically what happens, I'll explain in a minute, but it's mostly to do with the Federal Reserve, the central bank. So the Federal Reserve, they basically, and I'll explain in a minute, they have obviously two jobs. Number one is employment and wages, and there's a few of the things that they do to basically look after stable prices is their job. But yeah, here I've put a little small correlation, and I said that we still use the dollar index, we still use it, but the 10-year yield is really, and I'm going to choose exact moments that if you're following the yield, you would have known what to do on some of the Forex pairs. An example here. So this is actually quite important if you guys do want to note it down. So obviously these are two different scenarios. So scenario number one is whenever the 10-year yield is bullish, dollar index bullish, of course, because you've got USD at the start, that's going to be bullish. But then on the other pairs, you'll see a direct bearish correlation. So basically, whenever the dollar is going up, you're going to see a lot of the equities, stocks, everything else will go quite flat. And on the other hand, you've got, let's say the yield is on the bearish side of things. Dollar index can be bearish, USD JPY bearish, and then you'll get a lot of the majors that we'll be pumping a lot of money to. So I kind of put this here. And again, this is kind of terminology, and the way to kind of get this is quite weird. You have to repeat it in your head loads and loads of times for you to use this on a daily basis. But I promise you, if you start off your trading like this, it'll completely change the way you look at the market. So the first example here is, dollar. And I'll be showing you like a little rough sketch of how you should approach the markets and just use it. Just use it and you'll see how your mindset and opinion will change. But let's just say you wake up and you realize the dollar's firm. All that is going through some of the currency pairs and seeing, okay, right now, do we have dollar strength or do we have dollar weakness? With emerging markets, if you were to bet against the Turkish lira, then the swap will be the other way around. So your swap overnight, sometimes, so if you're betting against the Turkish lira, your swap sometimes can be 1,000% overnight to completely wipe out the positions. It's insane. So think about it that way. You've got huge, big players pumping hundreds of millions in, just hoping that in a year's time, it's exactly where it is. And then people who bet against it, who are being more risky, it can work out for them really well. But if the swap suddenly increases overnight, they're wiped out too. So emerging markets is one of the hardest markets to trade. So what we do is we look at the US dollar in those emerging markets and say, is the dollar strong or is the dollar weak? And that can actually give us a small forecast before we even get to GBP USD or before we get to Euro USD. Because sometimes there's a small lag there. So by looking at something that's a little bit harder to trade than what big institutions are looking at. So you'll always see it, like whenever you flick on Bloomberg and CNBC, you'll see everyone talking about emerging markets. And they're doing it right now. Because everyone's saying, wow, look at that huge move that just happened. So obviously I think the Turkish lira was like minus 14% over the weekend, which is insane. So you will see the dollar strength or the dollar weakness across, like, let's say, a few emerging markets, and you'll take that opinion and you put it into your major currency pairs. So, that's just a little bit of what, approach that I've been taking is starting to look into that. But before we get there, I'll just look at the 10-year yield for now. So risk on basically means that the risk is on. So imagine you're looking at a choice of a risk profile. That's the easiest way to explain it is risk on means, let's fucking go for it.
Yeah, we need money.
Yes. We need big returns. Let's just go for it in some of these emerging markets, some of these stocks in which the returns will be greater. And then particular days, a lot of people will go, okay, dollar is quite strong today. Let's not bet against it. Because if you obviously look at the stock market and the dollar, you'll see the correlation there. So if you look right now, it's 1.7%. So every single year, if big institutions and banks decide to buy a 10-year bond, in 1 year, they'll get 1.7% return. Now, one thing to consider is inflation. Because of course, that's also going to make the price of everything go higher. So normally what people think the actual real yield is a 10 yield minus inflation. That people call that the real yield.
Oh, that's the return.
Yeah, the real yield. Because obviously with everything's going to be more expensive next year by a little bit usually. So I swear, if you just type in or read everything, you'll see everyone talk, especially the past 2 months, about the 10-year yield. It's the first time it's ever been on a 7-week run. 7-week run, right? Where it's continued. So it went basically from, let's say, 1% all the way to nearly 2%. And the way to try and think about that is, picture cryptos, for example, right? When Bitcoin actually did go from 1 to 2,000, that doubling was quite significant. But getting from 55,000 to 57,000, not that significant. That's where you need to look at this. It actually doubled, in 7 weeks. And so, you're probably thinking, why do we care if it goes up so fast or goes down so much? So the inflation and the mortgage market, the whole of the mortgage market is based on this number. Everything. Every single country is looking at this and going, why is this moving up so fucking quick? And this is exactly what the dollar has been doing for the past while now. So the reason I did this, and I'll show you right here. So look, if you look at this period right here, let's just say towards what? End of February, you see this move, right? And since then, because obviously, let me just try and go to a daily time frame. And you'll like this. This is what I've found. So if you look there, let's call it just end of February, this run has been happening. It went from, let's say, 1.8%, went from 1.1 to 1.7%. So I've been noticing that even if you look at, the slight bit of pullback it had today, I noticed that it was starting to show a little bit of pullback there. And so the 10-year yield is just basically a bigger picture. It's basically literally the most important chart in the world. That's the way you got to think about it. The most important chart in the world, the safest bond in the world. Every single country across the whole world has to have a certain amount of dollars in their bank. So let me explain it again. If World War VII happened, everything collapsed, and you had to try and figure out how to get about, if you had dollars in your hand, it will always be known as the safest thing you can have in your hand, no matter what happens. If I wanted to buy Usman shoes, I was like, what do I pull out? Of all currencies, the dollar would be the one that everyone will always go, okay, I'll always accept that, because it's always safe.
What if you had some gold bars?
Gold bars could work too, but money-wise, the US dollar.
Yeah.
So what people have been worrying about is that this is going up too fast. That's the problem. It's not the fact that it's at 1.6%. It can go way up to 2-3%. But because it's going up so fast, that this is going to show the difference of expecting inflation in the United States. So the Federal Reserve, and so the Federal Reserve, like, I remember I used to teach the lesson about Federal Reserve when we first had Astro, but I think the most important, most secretive central bank ever, and they will make a decision. And so what's been happening is there's a Federal Reserve talk right now, there's a Federal Reserve talk tomorrow, and basically every single person, like across every single big news channel, everything is looking at this and they're saying, when the Federal Reserve going to do something about it? But for now, they're letting it just slide. They're just letting it slide. And then more people are being concerned. So now everyone is literally hanging off their every word. But the pattern which I have been starting to get accustomed to is waking up. Firstly, just look at the yield for anything crazy. Look at 3 to 5 emerging markets. And then look at your first currency pair that you're going to trade, which is obviously maybe the top G10 pairs or, top Forex pairs that you guys are trading. But going into that, thinking, okay, today, dollar is strength or the dollar is weak, and just look into that before making your next decision. It could actually just be the complete difference maker of what you're looking at. You could be looking at a key level and going, I wonder if it's going to break under, if it's not. But the dollar being on your side that day is going to help add to that decision.
Honestly, it was interesting because this is not something I'm using usually. So the fact that now I can implement this on my strategy, which is something I was not using before, it can be very interesting.
The way that Natt explained it gave me like a different view on how else I could use it, especially with the emerging markets such as the Turkish lira, and it was just really, really informative and really good to hear about.
I find that very valuable, golden nuggets here and there, and that's how it is when you're at Astro. You learn new things every day, and you can instantly apply it to your trading, and then the results show the fruits of your labor. So I found it 10 out of 10.